If your trading chart looking something like this, then you are in trouble because more indicators are not correlated with better strategy results. In this video, I will prove this to you. I will show you a single pattern that is traded on multiple Forex pairs with win rate above 85% on the major Forex pairs, and the pattern has been working for the past decade. Now, don't get me wrong, indicators are extremely powerful and we can use them to enter or exit a trade or to filter a trade. But I would like to show you how you can trade without indicators because patterns are as powerful as indicators. And today's pattern is no different. It is an extremely simple pattern that we will use on multiple Forex pairs exactly the same way. Here is how our pattern looks like. So it's a 2-bar pattern. The first bar, we don't care how it looks like, if it's up or down, it doesn't matter. The second bar is a down bar. So this is the long pattern. We are looking for a down bar, meaning the close is below the open. Also, the close has to be below yesterday's low. So only two conditions for this bar. It has to be a down bar and the close below yesterday's low. Once we have this pattern, then we will enter next day at the penetration of the current high. So if the price goes up through this level, then we will buy. If we buy, then we have two exit conditions. If the close price is above our entry price, meaning we are profitable, then we will exit. This can happen on any bar. If it doesn't happen for the next 10 bars, which is a number of fixed bars, then we will also exit. So two exits, either profitable close. If it doesn't happen, after 10 bars, we exit. And it's the opposite for the short pattern. Again, 2-bar pattern. The first bar, we don't care how it looks like. The second bar, which is the current bar, it has to be an up bar. So the close higher than the open. And also the close has to be higher than the previous high. Once this pattern happened, then the next day we are looking to short at this low. Once we are in a short trade, then if the close is below our entry price because we are shorting, that means we are profitable. So we will exit. This can happen at any bar. If it doesn't happen for 10 bars, then we will exit. Now in this video on purpose, I didn't pick the best pattern to trade. I also didn't pick the best market to trade. I just wanted to show you that this is extremely doable. You can easily find a pattern to trade on any market. So here I have the US dollar, Canadian dollar Forex pair represented in futures with a symbol CD. And the strategy is applied long and short. Let's look at some examples. So here is a buy example. So we have a down bar, which is the close lower than the open. And then the next day, the bar penetrates the previous high. So we enter. Also the same day, the close is profitable. So we exit. Now you notice here, these are all down days, but the next bar never penetrates the high. This is a short trade, an up bar, and then the next day, the bar penetrates the low. So we enter short. Now we wait for a profitable position or 10 bars. In this case, we get the profitable close here. So this close is profitable. And then we exit on the same bar. This is a short trade and the low penetrates the previous low because this is an up bar. We enter short, but we don't get a profitable close. So we exit with a loss after 10 bars. Looking at the strategy results, we have 249 trades since 2011. 126 longs, 123 short. And we notice immediately the long side doesn't perform well. So the short side is making $128 for the Canadian dollar. This is really good average trade because the tick in the Canadian dollar is 6.25. So 2 ticks and commission is like $20. So this is really good. So even this is profitable with including commission and slippage, but it's not the best. This is the equity curve. It's a very good equity curve going up all the time. And these are the annual returns since 2011. And you see how the win rate is amazing for the past 14 years. We can see for the short side is 91% and for the long side is 84%. Now let's look at other Forex pairs. This is the Swiss franc. Again, about 200 trades, split in the middle. Again, very high win rate for both long and short. But the short side here is amazing and the long side is not tradable. This is the Japanese yen, and this time the long side is losing a lot. But the short side, again, it's very good. This is the Australian dollar. Again, about 250 trades. Very good win rate. And this time, both of them are not that good. And finally, this is the Euro US dollar. Again, about 250 trades. And this time, both sides are very good. So the short side is $302 on average with a 91% win rate. And the long side is $150 with about, again, 90% win rate. So both sides are amazing. The equity curve, again, alone is amazing. And the annual period analysis, all of them are profitable. And you can see how the fluctuation in the win rate is minimal. You can see we are going from 83% all the way to 100%. So the strategy performs best on the Euro US dollar. Remember, all these Forex pairs are against the US dollar, with the Euro performing the best and the Australian dollar is the worst. So here is a portfolio of the 6 major Forex pairs. So USD against the Japanese yen, and USD against Swiss franc, British pound, Canadian dollar, Australian dollar, and Euro dollar. Only the Euro dollar is trading long and short, and all the other strategies are trading short only. And this is how the equity curve looks like. It's amazing, going up all the time. We have 800 trades on the short side and 127 trades on the long side. Remember, this is only for the Euro dollar, and both of them achieving the same average and very close win rate. So overall, we have 88.5% win rate with about $150 on average. This is the periodical analysis. Since 2011, we have all winning years with an average of 70 trades per year. This is the contribution from every symbol. So the Euro, because trading long and short profitably, it's about $56,000. The next best is the Swiss franc on the short side, only about $27,000. And the rest are double digits. And remember, the Australian dollar is the worst one. And we can see how is it doing. So the short side alone is 77. Now, remember, it used to be 50 with the long side, but because we eliminated the long side, so some trades will have time to work, and that's why you get higher average trade. And this is the best part. The correlation between all these strategies on weekly basis is like this. And the highest correlation we see between British pound and the Swiss franc. But even then, this is 0.2, and it's almost like this is considered nothing. Anything below 0.3 is really considered very, very low correlation. But here we have 0.05, 0.02, and 0. Now, this is very, very good when you are constructing a portfolio. You want this correlation to be very low. So every strategy is working alone. Also, this will help you a lot when you are capitalizing this portfolio. So the less correlated the strategies, the less capital you are going to need to trade this portfolio. Now, why this portfolio and all the strategies? I started them since 2011. So this is the same portfolio, and now we are starting in 2008. And we can see a big drawdown starting around May 2010 and ended in May 2011. Now, this doesn't mean that you cannot trade this. Still, the strategy is amazing. One single pattern on 6 major Forex pairs and doing very well. But this type of drawdown, we can easily filter it out with basically a strategy filter. But because the strategy has no filter, it's only a pattern, that's why. But I'm going to show you a simple filter that you don't need even to code it in. You just need to look at the chart. So this is the S&P 500. And you might say, well, why you are doing a filter on the S&P 500? Remember, we are trading all these pairs against the US dollar. And of course, the S&P 500 is the best representative index of the US economy. So this is a monthly bar on the S&P 500. And using the 50 bars on the monthly chart will keep you on the right side. So you can see here, July 2001, we get out in October 2004. And this is July 2008. We get out in December 2010. We can add a 10 bar. So again, on the monthly chart, the yellow line now is the 10 bar moving average, and the red line is the 50 bar moving average. And now we can use the cross as the filter. And the advantage of the cross now is we will be on the right side with these. So you see here, the yellow is above the red, again here, again here, again here. So we are always on the right side. And we still get out of these drawdown. Now, even though I showed you that you can use a single pattern to trade 6 strategies in a portfolio, that is not the best way to go about it. You should use all available patterns, add filters with indicators, and produce robust strategies that you can combine them in a portfolio to trade profitably. If you like this video, then you will love the next one.